Capital and revenue. Correct allocation should be made between capital and revenue. If not, the profit and loss account will not reveal the correct profit and the balance sheet will not be revealing the correct valuation of assets and liabilities. This may in turn allocate more profits, which will in turn be paid to the shareholders of a company, the consequences of which will have to be put or blamed on the auditors and directors of a company. Hence, capital and revenue is an important topic in auditing, in particular in any forms of auditing. The items of capital and revenue may be classified as revenue expenditure, capital expenditure, revenue receipts, and capital receipts. Now we'll see what is revenue and capital expenditure. So first we'll take a look at revenue expenditure. Out of the total expenditure incurred, a portion is charged against revenue when profit and loss account is prepared, and the remaining portion is shown in the balance sheet. The amount that appears in the profit and loss account is called revenue expenditure, and the amount shown in balance sheet under assets are known as capital expenditure. In other words, capital expenditure is the expenditure which is involved in the acquisition of an asset, both tangible or intangible, and which can be sold and converted into cash, or which may result in an increase in the earning capacity of the business and which will last for a long time to come in the future. Examples might be building, land, patents, machinery, etc. Whereas revenue expenditure in that case may be expenditure whose benefits expires within an year and which merely maintains the business or asset in good condition. Examples may be fuel cost, salaries, wages, etc. Now there is one other thing called deferred revenue expenditure, which are revenue expenditure whose benefits may be available for more than an year or less than 3 years. Next, we'll take a look at what is revenue receipt and what is capital receipt. So first it is revenue receipt. So it is receipts which are collected during the course of trading operations by employing the sale of goods and services are revenue receipts. So these receipts are collected during the course of trading operations by employing sale of goods and services. So that is revenue receipts. Whereas a receipt on account of capital profit, introduction of fresh capital into business, or sale of fixed asset is capital receipt. Now we'll see what is the duty of auditor in relation to capital and revenue. Auditor, while auditing the revenue and capital, should clearly make a distinction between the two. If not, may invite unpleasant irritables to the auditing process. If revenue expenditure is treated as capital expenditure, it would inflate the profits for the year. If any expenditure of capital nature is charged to revenue, it will reduce the profit for the year. So for the proper capitalization of the business, it is essential that fixed capital expenditure be correctly disclosed in the balance sheet, and auditors should make sure this indeed is the case by inspecting the balance sheet. So this covers capital and revenue. Thank you.